Hello guys, good morning. Let's get started. Stock market investing for absolute beginners. For those who don't know me, my name is Richard Nahano. We're going to talk about mindset, market basics, stock versus ETFs, risks, portfolio, research, and action plan. How money grows, how the stock market works, and how beginners can start with a simple long-term plan. After you finish this course, we can build a basic portfolio plan and understand what to research before investing. A simple path from earning money to your job to building wealth. As you all know, you do not need to be rich to start investing. You need a system, time, and consistency. You need to earn money first, save money, start investing money, and reinvesting your dividends or your profits. Let the money compounding itself, and then you can be financial freedom. Most people work for money forever because nobody taught them how to make money work for them. Most of us, we do 9 to 5 until we are 65. As you all know, when you're 65 years old, you don't have a strength. So when you're younger, the good thing you have to reward yourself is to invest while you're young, because you will not suffer when you get old. Why saving alone is not enough? Inflation slowly reduces purchasing power. Let's say, for example, $100 today. After 10 years, $100 will become $74. Your $100 will become, in 30 years, your $100 will become $41. So $100 in cash does not stay equally powerful forever. Prices can rise while your cash stands still. Investing is one way fighting inflation over long-term periods. If you don't invest, you're never gonna be rich. You wonder why people work for 30 years, but when they are old, they don't have money. It's just because they never invested their money. They put their money in the bank account, and the banker invests their money. Banks benefit from your money. You're not benefiting from your money just because you let your money stay in the bank. Compounding interest. The wealth snowball. A small monthly investing can become powerful over decades. Example, $500 a month at 10% annual return for 10 years is 1.3 million. So let's say, for example, 0 year 2026 now. So after 5 years, your $500 you keep investing every month, it's gonna become 39,000. You're gonna keep reinvesting that $500. After 10 years, it's gonna become 103,000. As you can see, your money, it keeps growing. After 15 years, it's gonna become 201,000. So after 20 years, it's gonna become 344,000. So after 25 years, your money will compound to 611,000. As you can see, guys, after 30 years of investing, your money will become a million, over a million. Don't postpone investing, because the time is the biggest investor's advantage. The early years feel slow. As you can see here, from $0 to 100,000, it took 10 years, but from 10 years all the way to 20 years, it became 300,000. The early years felt slow. The late years are where compounding becomes powerful. Just because your money, 100,000, will not compounding a lot of money. Like, you have invested 600,000. If you have 600,000 portfolio, it's gonna grow significantly. To reach a million, it's not gonna take you a long time. How the stock market works, a simple flow that beginners can understand. From investor to open a brokerage account, and until you buy shares of the company or ETFs. The market connects buyers and sellers. Your broker helps route orders. When you buy one share of the company, someone else sells that share to you. Let's say, for example, you buy one share of the Amazon. It means Jeff Bezos sell one share of his company to you. It means you own part of Amazon. You own one share of Amazon. As you know, stock market is ownership. You have to own something. What is a stock? A stock is ownership in the business. One share is one small piece of a company. You can make money from price growth and sometimes dividends. Let's say, for example, the whole pizza is the company. Each slice is a share, and owning a slice means owning part of the pizza. Same as a company. If you own part of the Amazon, you own slice of Amazon. Imagine you own slice of the company that worth billions and trillions of dollars. What is an ETF? An ETF, one basket can hold many companies. Instead of betting on one company, an ETF can spread your money across many companies, sectors, or asset classes. For example, SP 500 exposure to large US companies. Benefit of owning ETFs: lower single company risk for beginners. If you invest in ETFs, you most likely not to lose money, just because when one company is losing money, they're gonna take it out that company and add the company that is making money. ETFs are better. Historically, they return 10% a year. So it depends on the performance of the year, but historically is 10% a year. Based on your age and your risk tolerance, you can choose whatever you want to invest in. You can invest in single stocks or you can invest in ETFs. Understanding the risk versus rewards. Higher return potentially usually comes with higher volatility. Risk is not just losing money. Risk also means volatility, emotions. Most people, they have emotions, so when the stocks goes down, they panic and they sell. Poor timing. Let's say, for example, you buy when the company is overvalued. When the company crashes, goes down, you immediately sell. And lack of diversification. Let's say, for example, you buy one sector. You buy only technology companies. When the technology companies goes down, your portfolio goes down. Just because you bought only one sector, you have to diversify your portfolio. Match investments to your time horizon and risk tolerance. Guys, it depends on your age. As I said, if you are 20 years old, you can take risks. You can invest in good businesses and you let your money compound. So when the market goes down, don't ever sell because you invested in a good business. Individual stocks, you can invest in ETFs, bonds, and cash. Keep cash. So one of the things that has helped my portfolio is to keep cash in my portfolio, because when the market goes down, it's a better opportunity to me to buy. Other people are panicking, but for me, I'm buying high quality businesses. Types of investments. Different stock tools can play different roles in a portfolio. There's cash. The people who always keep cash, they end up poor because their money is by inflation and it's a volatility too. Bonds. Grow potential doesn't grow very much, but instead of keeping cash, you can invest in bonds. And REITs is a real estate. If you don't want to invest in a physical property, you can invest in REITs. ETF grows potentially. ETFs, beginner friendly diversification. And stock potential for high returns, but more company specific risks. If you invest, as I said, in a company that doesn't make money, of course you are in a risk. But if you invest in companies that are making money, there's no risks. Beginner portfolio example. You can start simple. You can diversify your portfolio, and it is easy to understand. As you can see, technology ETFs 20%, you can keep cash 10%, and ETFs 500 SP 500, you can put 60% of your money. Example, this is educational sample, not personal financial advice. Core ETFs gives you a broad exposure, smaller slice at growth, income, and liquidity. What percentage would make you sleep well at night? So if you put like a 50% in ETFs, it gives you peace, or in individual stocks, it gives you peace to sleep at night. When the stock goes down, are you confident enough to not bothering your stocks? So dollar cost averaging, this is one of the best methods we can use as investors, because we don't time the market. We let the market. We invest in downtowns, and when the market is uptrends. We don't time the market. Let's say, for example, January, you invest, market is $100. You buy $95. So February, you also buy. The market drops to 92. And March, you also buy 95, because you want to buy consistently and every month. Also, the market drops to 84. As you can see, April, you buy 95 and the stock market goes down to 89. You buy also in June, stock market goes to 103 and you buy 95. As you can see, July, you buy also, and August, you buy. As you can see, in long run, the stock market is always going up. As you can see, buy every month where prices are up or down. So it reduces emotional and builds a habit. And yeah, you can set calendar, like you flip buy. So let's say, for example, you get paid bi-weekly. After getting paid, so you can buy first. Market cycles are normal. We have bull, it goes up, it goes down. Bear market, it goes up, it goes down, it goes up, it recover, so it keeps going up. So crashes feel scary, but long-term investors plan for them before they happen. The worst mistake is often panic selling quality investments during fear. Bear markets can offer better prices for patient investors. Do not panic and sell when the market goes down, because I used to do that many years ago. When the market was going down, I was immediately selling. And so when I was getting fearful to go back, thinking that the market will go down again. 3 financial statements you can read if you want to start investing. The language of business ownership, income statement, balance sheet, cash flow. This is very important. You have to learn about these 3 financial statements if you want to build a profitable portfolio. So you have key terms. So in income statement, you have to know the revenue of the company, operating income and net income. In balance sheet, is the company financial strong? You have to ask that question and do the research. You have to know the assets, the liabilities, the debt, and their cash. In cash flow, does the business generate really cash? Key terms, operating cash flow and free cash flow. You have to know this if you want to build a strong portfolio and invest in individual stocks. Revenue versus profit. Sales are good, but profit and cash flow matters. Is the revenue growing? This first year, the company revenue is $100, and you want to see the company is consistently profit and revenue growing. So the net profit is 8. The second year revenue is 135, and the net profit is 12. As you can see, it grows every single year. The third year, you want to invest in the company that revenue goes up. As you can see, the third year revenue is 170 and the net profit is 20. The fourth year revenue is 210 and the net profit is 32. As you can see, it goes up every single year. So you want to invest in companies like that. So you can ask yourself the third question: can the company turn sales into cash? Stock research checklist, a simple framework for buying individual companies. So number one, you have to research the business model. How does the company make money? Growth, are revenue and earning growing? Third, profitability. Can it turn sales into cash? So you have to know the fourth. Is the balance sheet safe? The debt. You have to consider debt when you're investing in company, and you have to know if the debt cannot hurt the business. So moat. So what it means moat is what protects it from competition. As you know, if you invest in a company that have too much competition, it's a problem, because if the company is no longer profitable, so the stocks will drop, will crash. So you have to know what protects it from competition. Valuation, is the price reasonably? Like, good stock can become bad investments if you buy a higher price. So you have to wait the stock can go down so that you can buy. Most people, when the stock goes down, they panic. But it is a good time for you to do what? For you to buy when the company meets all these 6 criteria. The business model, the growth, profitability, debt, and moat, and valuation. So you have to invest in the companies that consistently making money. Valuation basics. A great company can still be a risk investment at the wrong price, as I said before. Let's say, for example, company A is 18, 25, 42, and 70. You have to check the PE ratio, price dividend by earnings. A quick but complete visual tool. Important: cheap does not always mean good. Expensive does not always mean bad. A cheap company, but it's a good business, that's an opportunity for you to buy. But also a good company and expensive, it can be bad to buy, because you might buy and the stock might go down because you buy when the stock is overvalued. Best practice: compare valuation with growth, quality, and risks. Dividends. Investing the income snowball. Dividends can be reinvested to buy more shares. Cash payments, some companies or funds make to investors. Use dividends to buy more shares and grow future income. Warning: high yield can be risky. Quality matters more than yield alone when you invest in the stock market. Let's say, for example, annual dividend income is $200. As you can see, the 5th year annual dividend income is 1,200. 10th year is 3,600. As you can see, it keeps growing. You have to invest in the company pays dividend. That dividend keeps growing. You don't want to invest in the company that dividends doesn't grow, so it will hurt your portfolio. Grow investing, finding companies that can become much bigger over time. What to look for: large market opportunities, strong product, and durable competitive advantage. Risk: growth stock can fall hard when expectations are too high. So best to use: keep growth stocks as part of diversified plan. So don't invest in early when they launch a company, unless you have observed, you know that it's not expensive. So early years, as you can see, the company revenue keeps going up. As you can see, 95 globally when they expanded their business globally. Growth investing. Index Investing versus stock picking. Two different paths for different skill levels. Index approach. Simple, diversified, lower effort, excellent foundation for beginners. Stock picking. It requires more research, patience, and emotional control. You can invest like 20% of your money when you're beginning in a single stock index. 70% of your money has to go to indexes, just because indexes are simple, diversified, lower efforts, and excellent foundation for beginners.